Okay, in this last video, what I want to do is look at depreciation expense. And depreciation expense is shown in the book, and I want to make sure I cover it. It's not, it is part of adjusting entries. It's not difficult to understand, but I want to make sure that we at least talk about it. Depreciation expense. Let's go back to start with our accounting equation. Assets equals liabilities plus owner's equity. Under our assets, there's different kinds of assets. There's current assets. Current assets are assets that are likely to be turned into cash or are cash within 1 year. So cash, marketable securities, accounts receivable, inventory, and prepaid. Those are part of our current assets. And after current assets, we have long-term assets. And those are things like our property, our plant, PP&E, property, plant, and equipment. It's down here under property, plant, and equipment. This is where depreciation expense comes into play. And the reason for depreciation expense is that we are allocating the expense portion of our property, plant, and equipment over the period of time that it generates or is estimated to generate income. It's part of the matching principle, matching revenues with expenses. And so it's that, and it's the accrual accounting of recognizing revenue when it's earned and expenses when they're incurred, that we have this depreciation expense. So what is depreciation expense? I want to teach it by going through an example. In this example, we have a company and we make buttons. Our name of our company is Buttons R Us. Buttons R Us. We make buttons. It's the name of our company. We manufacture buttons. And so you come to us and you say, can you make 1,000 buttons for us for the Traverse City Film Festival? And we say, yes, no buttons too hard for us. Your buttons are us. And we say, we will make those buttons for you. Well, in order to get this company up and running, we have to buy some kind of a machine that makes buttons, right? We'd have to get something that would show up on our balance sheet down here. We had to buy the button making machine. And let's just say that when we bought that machine, what would the entry for buying that machine look like? We would be, and we paid cash for it, let's just say. We would be debiting our button machine, but machinery. Button machine, when we would credit cash. And let's just say it cost $10,000 to buy this machine. This button machine is an asset, and cash is an asset. So our accounting equation, assets equals liabilities plus owner's equity. Our assets went up by $10,000 because of the button machine, and our assets went down by $10,000 because we paid cash for it. So on our balance sheet, we're going to have under long-term assets and property, plant, and equipment something that says button machine, $10,000. Now the question is, how do we handle the allocation or the expense of that asset over time? Let's say, for sake of illustration, that this $10,000 piece of equipment, it has an estimated life of 10 years. When we bought it, they said, how long is this thing going to last? They said, well, the estimated life of that is 10 years. And we say, at the end of 10 years, is it going to have any value at all? And we say, let's use a crazy illustration. Let's say, yes, it's going to have value of $5,000 at the end of 10 years. We say, wow, that's a pretty good button machine. It retains its value. So $5,000 is the estimated value at the end of year 10. So 10 years, it's only going to go down $5,000. Well, from a picture perspective, we're going to spend $10,000 here, and I'm going to draw my time period. And let's just pretend this goes to year 10, but let's go time period 1, time period 2, time period 3, time period 4, time period 5. This goes all the way to time period 10. We have to take the $10,000 that we spent for this machine less the $5,000 what it's worth. So we have the cost of $10,000 minus this, it's called the salvage value, minus the salvage value of $5,000 equals $5,000 that we are going to depreciate or expense over a 10-year period. And so we take that $5,000 and divide it by the 10 years. That's the useful life is what? $500 a year. So we need to record as an expense $500 at the end of a year. These are years. 500 at the end of year 1. Another 500 at the end of year 2. 500 at the end of year 3. 500 year 4. 500 year 5. All the way to year 10. Now, so when we record the depreciation expense, it's a $500 journal entry that we're going to be making. And when we make it, the entry is going to look like this. We're going to, the adjusting entry for the depreciation expense is going to look like this. Debit depreciation expense, $500. Credit, and this is, we're going to credit something called accumulated depreciation machinery or button machine, $500. Now, this depreciation expense, assets equals liabilities plus owner's equity, and then what's impacting owner's equity? It's net income, which is revenue, minus expense. This depreciation expense is an expense account, so it shows up over here on our income statement as an expense account. It reduces net income, which reduces owner's equity. So owner's equity is going to go down. Now, what is accumulated depreciation machinery? This is what it's called a contra asset account. It means it's set against an asset account. What is the asset account that accumulated depreciation machinery is set against? Well, it's set against machinery. Button machinery, $10,000, and we have accumulated depreciation machinery of $500. So on the balance sheet, as we're presenting our financial statements, and we're reporting our financial statements, we will see, let me get a different color pen. We will have under assets, we will have our machinery listed at cost, $10,000, and then it will say less accumulated depreciation machinery. And that will be, in this case, $500. So it will be reported as 10,000 minus 500, which is $9,500. That's how much will show up on the balance sheet. And you'll notice that our balance sheet went down by $500. Our owner's equity went down by $500, and our assets also went down by $500, keeping our accounting equation in balance. What happens is every year, year 1, 2, 3, 4, 5, as the years go by, we'll continue to make these adjusting entries for $500 every year, and then at the end of year 10, we'll make another entry just like we normally do. And what you'll find is this accumulated depreciation machinery figure is going to go up every year. So at the end of year 1, let me see if I can do something here. Play around here for a second. Yeah, let's do this. Let's make some more room here. So at the end of year 1, here's what our accumulated depreciation will look like. Our accumulated depreciation machinery. Draw it as a T account. At the end of the first year, it has what? A credit balance of $500. That's for year 1. Year 2, we put another $500, which gives us $1,000. Then year 3, we have another $500 going in of depreciation expense, which gives us $1,500. And you keep going till the end of year 10. And at the end of year 10, the balance in this account will be what? It will be $5,000. So that what's reported on our financial statements at the end of the 10th year, we will see machinery and equipment, button machine, right? $10,000 less accumulated depreciation. How much will it be? $5,000 less $5,000 to give us a net value of $5,000. That $5,000 net is our salvage value that we have established up here. It is a 10-year life with a $5,000 estimated salvage value. So over the period of 10 years, this is what we will show at the end of that 10th year, so that our net value, our net asset value for the button machine will be $5,000. So we've taken $5,000 and expensed it. This is depreciation expense. Every year we have shown $500 in depreciation expense. And in our asset account, our contra asset account, accumulated depreciation, we have accumulated $5,000 worth of depreciation against the $10,000 cost, giving us a net book value, a net value. It's actually net book value of $5,000. So we're going to have a whole chapter on long-term assets and depreciation expense and using different methods of depreciation expense. In fact, I made an assumption here that I didn't say, and the assumption is this, that when we are depreciating this $10,000, or actually this $5,000, when we are depreciating it over 10 years, we're going to do it on something called a straight line basis, which is you just take the 5,000 divided by 10 years, gives you 500. There are different approaches to depreciation expense. We'll see that when we look at property, plant, and equipment, long-term assets in a future chapter. But for sake of this illustration, just let me say that I've made an assumption here that this is a straight line depreciation. So there you have it, depreciation, accumulated depreciation. Again, we're doing it because of this whole idea of the matching principle. We want to flow things. We want to make sure that everything flows. We have an outlay of $10,000, okay, and it goes over a certain period of time for 10 years, and we're going to have to handle some here in time period 1, some here in time period 2, some here in time period 3, some here in time period 4, and for the way we did our math up above, it was $500 in expense, $500 in expense, $500 in expense, and at the end of 10 years, we only have $5,000 left over, but we're matching it. We're recording the expenses when they are incurred. Incurred because we're saying that this $10,000 piece of equipment is going to provide revenue for a 10-year period. You know, we just got one order for 1,000 buttons for the Traverse City Film Festival, but this machine is going to be generating revenue for us over a 10-year period. So we want to match expenses as well over that 10-year period as best we possibly can. So that's a kind of a quick and dirty on depreciation expense and the establishment of a contra asset account. So this is going to wrap it up for Chapter 3, and I'll see you as we begin to push into Chapter 4.